So I noticed a very different kind of bubble, financial bubble creating in our markets today. Yes, 2008 real estate bubble, US real estate market. 2000s tech bubble, dot com bubble. Most people call it dot com bubble. That was also Nasdaq bubble. Nasdaq valuations were sky high. So in 2020, you may be saying, yeah, passive investing. Everybody knows what is passive investing. It means you give your money to a fund which is called ETF, exchange traded fund. And these funds, how do they work? How do they work? These funds work and they have very simple decision making process. Very simple decision making process. You give them a dollar, yeah, they take your dollar and buy the securities under it. Let's say ABC, it's a ETF tracking the performance of ABC markets. So they'll buy equal or weighted shares of ABC. But and when you ask them, when you redeem a dollar, they will sell this ABC, they get dollars and they give you your dollars. So it's quite simple. There is nothing to worry about. No. BlackRock and Vanguards. These are the two huge ETF managers. They have north of 21 trillion funds. They manage north of 21 trillion funds. So they are quite literally big. So how is the bubble here? So it came to my notice when I saw an article, I heard in news the Michael Burry who very successfully predicted 2008 real estate bubble. He was the first one. I mean, he claimed to be the first one. The very hit movie, very famous movie, Big Short. Big Short shot Michael Burry to the fame. Yeah, Big Short shot Michael Burry to the fame, because in this movie it was clear that Michael Burry was the first one. He was the genius who predicted this. And Michael Burry in 2019, he gave the warning. He warned us about the passive bubble which can burst in 2020 or maybe 2021. What is this passive bubble? Let's see. And also, I need to give credit to Grant Williams podcast. Grant and Bill did that amazing podcast. I'm a huge fan of both of them, with Mike Green. And Mike Green's work is amazing. He is Logistica Capital. He CEO, I guess, CEO, or I don't know. He is the senior most person here, and he did a magnificent work on this passive investing. He's the king, passive king. I I want to say passive king. So what's it about? So in passive, I show you how the process works. You give them dollars, they take your dollars in the funds and they go out and buy ABC securities, irrespective of price, future of the underlying companies or valuations. Nothing, they don't matter. It's nothing matter. If you are telling them to buy a certain index and you are giving them money to buy that index, they will buy that index. They are like very little human intellect. It's just like a machine, it's a computer, it's a algorithm. You give them money, they take your money, they buy that. So not a big deal, right? But the passive investing, it's good as long as it's net inflows. If net inflows, and I'll try to explain you. It's a little complex, but still I try to explain you. If net inflows are positive, it's well and good, it will work, right? Market will go up and up and up, and buy and hold strategy, you buy here an ETF of certain dollars, and it will go, it will become certain, it will appreciate, like buy and hold strategy. It will work. Buy and hold strategy will work. Management fees, mostly active funds, in active funds they have 1 to 2% or maybe more or less, but in this ETF 0.05, 0.01, yeah, it's like negligible, so you are saving a whole lot of management fees here. And Warren Buffett very famously, that ETFs are a very, very effective investment tools. So Warren Buffett is a big name in investing. So we need to, I mean, that shorted to the popularity. And in US market, the share of passive funds have increased tremendously. It's around 45, I guess 45 or 47% passively invested funds, so that's great. In worldwide it's around 35 to 40%, so it's great. And if we compare it with 2000s or 2002 3 2002 or 3, it's just about 10%, 2% maybe. So it's a huge increase in passive. So what's the problem here? What's the problem? So what are the problems with passive investing? Why I am calling it a bubble? Why Mike Green is talking about a catastrophe? Why Michael Burry is talking us about a next big short? I mean, there must be a problem. So first, a very widely known, very logical, common sense, it creates malinvestment. I won't waste much time in this, but it's a malinvestment. You very well know why it's a malinvestment. You are buying an index, the whole index you are buying. You are not looking, maybe this security is overvalued, have a very bleak future, no earnings growth, high capex, high debt, on verge of bankruptcy. I mean, if it's included in the index, your fund has to buy this. If you are giving your money to the fund, it has to buy this security also. This security also. Maybe this is a very magnificent security. It may give you a 10x results, but it may give you minus 100x result. I mean, it's just an example, but you got my point. So there is no non discretionary buying. Non discretionary buying, I would like to call it. We don't know what we are buying. We are just betting on an index. We don't know what is underlying the index. So the second main fundamental structural problem with this passive investing is really, which I understood after I heard Mike Green. And Mike Green explained it very, very professionally, and like very, I can't just tell you enough that it's great. This guy is great. The work is magnificent, research and everything is great. So, what the statistic says is, when there will be a point, and what that point we don't know, there will be a point where the market share of the passive will be somewhat very big. It's already huge, at 50%, almost 50%. It's huge, but it will be certain, I don't know, it may be 80, it may be 70, it may be 60, it will be somewhere. And there will be a trigger, like in generational, boomers are retiring and our millennials are coming and they want to spend, they need money for anything and everything. And so if there is some a trigger, and where passive funds constitute around 50%, 60%, 70% or something. And this is active guys, this is active hedge funds and active funds. So here what's happened, like Mike Green said, you can count on your single hand the days or the periods where BlackRock, Vanguard, and passive funds had net outflows. Net outflows is very important. When you had sustained or not sustained, if you have only 1 month net outflows, you know what? There are net outflows. There are some people are buying, some people are selling. So far so good. But when the outflows exceed the inflows, so then what happens, they had to, obviously if you're redeeming your money, they have to sell the securities. Whom they will sell? If they will sell to another passive fund, the passive fund will buy. If they had money, they will buy at any price. They are non-discretionary buyers. But if they are net outflows, an active manager holding that security, then this security, they'll give you money by selling the security. But now the price is bidded up to $500, let's see. And that's what ETFs directly proportional to volatility, they increase the volatility, because whenever you give them money, they just buy the fund. So the price action really, it's long volatility. So now they have to give, they owe you $500 on screen. You can see you have $500, but then they go to the market, they want to give you $500. How will they give you? They'll sell the security, they will sell the security to someone. Now they'll sell security to some active manager or hedge fund. He'll say no chance, I won't buy this. Then he said, okay, 490. He said, no, it worth $10. And so what? They have to sell at 10. And your $490 haircut. No, 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 no. You can't take that. And what if, I mean, this is doomed, man. This is set to doomed. This is a time bomb waiting to happen. Also, Vanguard and BlackRock. Vanguard, BlackRock. How do they earn? They can't earn from 0.01, 0.05, 0.01, 0.001. This is very, very minimum fees. Marketing costs are too high. How do they earn? They lend out the securities they have. So securities have now become just like commodities, like Comex. People tell Comex as Crimex because what? They have future contracts, naked future contracts, which don't have underlying commodities in it. What happens is they are trading for like 100 million ounces of gold, and they don't have 100 million ounces. They actually have 10 million ounces for actual delivery. So they are settled in cash. But in securities, this is a paper market. This doesn't work like this. But they are, I mean, that's a terrible idea. That's a terrible idea for PNL of Vanguard and BlackRock. They started lending these securities. So first of all, whom they lend, they are also experiencing the same lift in price whenever market is going up. And then again, they are increasing the demand, and obviously original number of securities are less, and like 25% securities are lended, so there are 125% of securities. And it's, believe me, it's much more than that. It's like 200, 300%. Like in March we saw massive sell off, February, March. That volatility increased due to this factor only, but it was controlled in a large way by the active fund selling this. What if next time the passive outflows far outnumber the active outflows? Market can trade to $0. Market can trade to $0. Yes, I know it's a little complex and it's hard to digest, but it is totally true. and my green has run their simulations in which it was showing it can go to $0. I mean, how can you sell a security for $500, which is pride bidded up by your ETF fund, but an active manager having only $10, how can he give you $500? Let's say they don't have $500. This That's another thing, that they have $500 but they are willing to buy it at $10. Let's say they don't have that, due to the super increase in demand which you have created by lending out the securities. So that is just, they are the, I don't want to say that F word, but they are criminals, man. They are criminals. And so this is what the passive bubble explained. And the question is, if it's going to happen? No. When it's going to happen? The question is when. And there will be a time when the net outflows are going to uh, outnumber the active managers net inflows, and that's very 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 likely possible. Probability is very very high. So that's why I sold all my passive funds. I had Nasdaq ETFs, S&P 500 ETFs. I sold all of that. So thank you. And I tried to explain you a very 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 complex topic, so it will be like a very complex topic into, very organized way. I'm not a very good teacher, but still I tried. So please like the video if you like, and thank you very much.